Hi there, Port here, and as promised, everything within this video is definitely for entertainment purposes only and somewhat educational purposes, but I am not a stock advisor. I am not your advisor. I am not a financial advisor. I am in no way advising you to do these things. So do with this information what you will. And with that, let's do this thing. Okay, so stock market's going to shit. That's just what it is. We've entered a bear market, and with that, on average, bear markets usually take about 200, 250 days to reach a bottom. And the rate of speed at which this is increased is alarming. And I don't think we're at the bottom. I don't know. Again, educational purposes only, and I am not an advisor. But this is definitely having just hit a bear market in the S&P 500. I think there's still more room to drop, and I honestly think that you may see the S&P 500 drop all the way down to 320, the SPY 3200, but 320 for SPY, which is the thing that I usually go by. Now, you may not be able to see it on my, screen. However, over here, if you take a look, you'll see the S&P, the SPY, what we look at currently 366.26. So, and I've already taken the liberty, and I'll actually just redo this because it seems easier to do it this way. So these are all the different options plays that I have right now, plus one share of SPY just for funsies to track it. I bought this when it was 400 just to see where we went from 400. Now, this is Thinkorswim. This is TD Ameritrade's like stock and options baby. For those of us who aren't born in the 60s. It's a little more user friendly, I think, than TD Ameritrade's current offerings. But so essentially, you have a list of different options dates, expiration dates, and I think maybe one of them that might be a good choice is somewhere in the middle of July. So let's say July 15th. That's about a month out. Now, the current price, you can see this is the dividing line right here, 366. So you got your puts on the right, you got your calls on the left. Now I've not gone over, well, on YouTube, how to do just a regular call and regular put, why you would want to do that. This is a little more advanced than that, and I will get back to the less advanced things. But this is more for educational purposes for what's coming. So my thought process is that because inflation is still rampant, because of all these different issues going on globally, politically, what have you, you're going to see a bigger drop. So a month from now, let's say July 4th weekend's coming up, and it is. July 4th, you're going to have so many people buying lots of groceries, traveling a lot. So you're going to have an extra demand on grocery, you're going to have an extra demand on gas. And that will spike the price per barrel of oil because there's more demand. Raising of prices, how you try to kill demand. Raising of rates from the Fed is how they're trying to kill demand. These things are what economies use to kill demand so that the supply can catch up. It's a very simple process. Supply and demand economics. It's not a very difficult thing to grasp. The nuances are where people get caught up, I guess. So because of this, I think after July 4th weekend, you will probably see a drop. So to give yourself a little time, because no one can predict the markets, July 15th seems like a reasonable thing. Now, these options prices, we're going to look at the put side because we believe things are going to go down. And you look at these option prices for a month out. Now this right here, this 366, well, it's $11. It's 11.05 for the ask, right? That means to buy this put, it would cost you $1,105. That seems a little high because we're in a volatile market. The price of options is also much higher than normal. And so if things start to stabilize and become less, volatile, the prices on these start to shrink. So if you buy this now at this price, that volatility could kill you if the volatility stops, and it's just a gradual, slow burn. So in order to break even, if you were to just buy this at 366, that means that just to break even, this thing would have to go all the way down to 355. Not unheard of. It could happen. But that's just you reclaiming the money you purchased this for. In a month, the S&P 500 would have to go down $11. Now, this week alone, there was one day where it went down $15. So it can happen. But to defend yourself against the volatility of the market, to defend your position and your idea of the fact that you believe the market still has further to drop, this is what I'm going to recommend. And again, entertainment purposes only because I have to. So let's say you buy this, and then let's go $5 down. Let's go to the 365. There you go. That's 1062. And then we go down to the 360 and we hit the sell. So we're going to buy, and just for simplicity's sake, we want one of each option. So we've recorrected so that there's one of each. They're both July 15th, 26 days out. You're going to buy the 365, you're going to sell the 360. And for this, it should only cost you $1.96 or $196 because you have to multiply options prices by 100 because each options contract represents 100 shares. So if I've lost you, just bear with me. And if you have any questions, I'm happy to answer them. Leave a comment and I'll take care of it. Now, with this, that's a $5 difference per share. So the most you can make is a total of $500. And since you've put in roughly $200, that means your $200, if you're correct by this date, you should get an extra $300. So your 200 plus 300 gives you 500, which is the difference between those two prices. If you're right, then you get $200 or $300 extra on top of the money you've risked. If you're wrong, you will lose all 200 of your dollars. However, I would rather lose $200 than $1,000. So basically what you're doing is you're buying this option because you believe that the S&P 500 is going to go down. You just don't know by how much. And then you're selling this option here, the 360, because if it goes down below 360, and that's only $6 away, you've basically, made your 500. You've took some off the top. You can sell this as one whole unit option basically afterwards. You're going to lose out on some profits down here, but you also didn't have to spend nearly as much to do it. So it's a little bit of a trade-off, but this also defends against the inflation, or not inflation, the volatility, because no matter what, even though this is volatile, this is also just as volatile. The volatility is the same throughout the market. So even though this price is high, this price is also high. So you're selling this premium to kind of negate the premium here. So it's really like you're buying a limited version of this 365 option. You're only going to be able to make $300 off of it, but you're also not going to lose $1,000. So it's a little bit of a hedge. And this is what they call a put debit spread. So you can look that up on, YouTube or wherever to take a look at the different. You have put credit spreads, put debit spreads, call debit spreads, and call credit spreads. Those are the four basic ones that you probably need to know and research. And I will be doing a video on each one of those after we get through the basics. But this is one that I wanted to give you because I believe it may be beneficial if you're willing to do education and research yourself. So with that, if you were to just look at these things and then you come down here and it's got a nice little graph for you here. This is the position. So it shows you right here. Your break-even point is 363.20 because all this red means the higher it goes, you're only ever going to lose that $200. You can see the graph, the way they've laid it out, it's really great. And then as soon as you go beyond that 360.20, you're in the money. And once you go below that 360, you are at your max price. So if this expires below 360, you're at your max price. And both those options will be exercised. It'll look real wonky if you let it go to expiration. Your account will look real wonky, like you just lost like $30,000, $36,000 or something, because it's basically buying the shares and then selling the shares. And it may do that in a weird order, which will look like your account's like negative or something. So don't panic. That would be normal. However, I don't recommend holding it through expiration. I recommend selling it when you've doubled your money at least. So you've got $200 into it. So if you can ever sell it for $400, let it go. You've doubled your money. You've came here and you've hedged your bets against all your long positions losing, and you can do more than one of these because it's only costing you $200. So rather than buying, one $1,000 option, if you buy 5 of these at $200 a pop, you can do the same thing essentially, but at a much more limited exposure and a much more limited loss. That's my theory on that. Now, you have to be careful. If you don't know what you're doing, I do not recommend you do anything of the sort. But this is a nice way to kind of hedge your bet with a little bit of money so that if things continue to go down, you're not losing everything. You still have a little bit of, upside. You can buy a put directly and just hold it and hope it goes. And if it goes down, like if you have an October put, which probably cost you $1,600, you could do that and hope that it goes down and you make money on that. But the longer term options cost more. And the short term options have a little more volatility, cost less, but you can also get real screwed real quick. So that's up to you. And just a fair share, because I know a lot of you don't use Thinkorswim. Some of you use Robinhood. So we're going to do the same thing on Robinhood. I don't have a Robinhood account anymore. I blew it up. I got everything off it because I don't like Robinhood, but I know a lot of people use Robinhood. So we're going to go through how you would do that. So you get on SPY, it's ticker, and you see SPDR S&P 500 ETF 366.33. You come over here to trade SPY options. And then the first thing that should pop up is the June 22nd. Now you can change the date. Up here, you go to July 5th, or even, what were we doing? We were doing July 15th, midway through July. And so if you come all the way up, you go to puts, because you have buy, sell, call, put. And so we are all the way down here. Okay, so there's this line right here. That's the share price, and it'll tell you what's above and below it. So this is kind of weird because it doesn't have all of them, but essentially you come here, you do. If you were to buy the 365, like we said, then you click over to sell the 360. It does all the math for you right here, and it shows you 1071 for the one you're buying, and then you get a credit of $872, which makes your total cost $200, $199. And then they also have a nice little expected profit loss thing too, which I think is a really good thing. So give credit where credit's due. And it shows you right here at 360, that's where your max profit is. And then it tells you how much you'll be up, and this is your break even, 363.01. And then your max loss is a 365 and above. So you have a nice visualization. So anything in the green is good, anything in the red is bad. And yeah, and it tells you your max loss is 199, your max profit's 301, and your break even says all these things right here. This is a beautiful thing, and I wish every single brokerage would do something like this because this is excellent. This is a real good thing, real good indicators. You just click continue, you buy it, and you wait and you watch. And that's all you have to do. And again, all of this is not financial advice. This is for entertainment and educational purposes only. So trade at your own risk. And with that, I'm poor. Trade well, be safe.